Welcome back to the deep dive. Some companies, it feels like they operate in two completely different dimensions at the same time.
Oh, for sure.
On one hand, you have these wildly futuristic, almost science fiction level goals. Think robotaxis, humanoid robots,
Hmm.
and valuations aiming for $1 trillion.
Right, the big picture stuff.
Exactly. But then on the other hand, they're still just running a business, a manufacturing and sales business based on, physical metal, supply chains, and consumer demand.
The old school nuts and bolts.
Today, we are talking about Tesla. And we're unpacking a story that I think illustrates this tension perfectly.
It really does.
We have this massive forward-looking strategic shift, right? Driven by a huge shareholder vote. And then almost immediately, it's undercut by a very real, very painful business problem.
A big one. Rapidly declining vehicle sales in the world's most critical EV market, China.
So our mission today is pretty simple. We want to understand this paradox. Why do quarterly sales dips still matter when the whole market seems focused on a 10-year robot-powered future?
And what do these two completely opposite data points really tell us about the foundation that's supposed to be supporting that massive ambition?
Let's start there. Let's start on the ground with that painful reality.
Okay, so we have to start with the stark numbers. Reports citing the China Passenger Car Association, the CPCA, show that Tesla's auto sales inside China hit their lowest level in 3 years in October.
Wow.
3 years.
And this wasn't just, a slight dip. We're talking about sales sliding down sharply to roughly 26,000 units.
26,000 units. I mean, that is just a brutal headline. It caused the stock to slide more than 2%, right? Even more than the general market.
It did.
Usually that kind of performance in a flagship market like China, it just causes panic. It suggests your market share is absolutely slipping away.
It does, and it might be. But here's the necessary nuance, and this is why the whole story is so complicated.
Those same reports noted that while the domestic sales were way down, the overall factory output wasn't necessarily collapsing. We saw rising shipments of China-made Teslas being sent to international markets.
Oh, so they're still making the cars.
They're still using the Giga Shanghai capacity,
Yeah.
but they're struggling to move the metal locally within the Chinese market itself.
Okay, that's the first layer of complexity they're producing. But the domestic appetite is just waning. So let's challenge the premise here. This major sales dip, this clear, quantifiable pain point, it seems to be fading into the background.
Right.
Our sources suggest that overall investor attention is, and I'm quoting here, largely elsewhere. Why? I mean, why would a 3-year low in the biggest EV market on the planet not dominate the conversation? Are investors just ignoring reality?
I think the answer lies entirely in the calendar timing.
How so?
This sales news landed almost immediately after one of the most significant moments in the company's recent history, the massive shareholder vote that approved the gigantic new pay package for the CEO.
Right, and that wasn't just about the money.
Not at all. This was a formal commitment.
Yeah.
That vote, it served two massive purposes for the investor community. First, it removed a huge amount of uncertainty, this overhang about whether the CEO was really committed to seeing this next decade through.
It locked him in, basically.
Yeah, it locked him in. And second, and this is the crucial part, it formalized the strategic direction. It was a formal public declaration that this company is committing everything to transforming into a technology enterprise.
Powered by robotaxis and AI.
Exactly. Not just a car company.
So, in the minds of the people setting that huge valuation, the strategic vote was just a bigger piece of news than the operational performance in October.
That's it.
They basically saw the drop in China sales as market noise, a temporary speed bump on the road to a $1 trillion robot future.
Precisely. They're trading on the vision of 2030, not the sales figures of Q4 2024. And that focus on the future even led to a classic sell the news reaction right after the vote. The stock briefly dropped because the good news was in, the uncertainty was gone.
Right.
And then it stabilized, influenced by bigger market stuff like optimism about the economy or a government shutdown ending. The point is, investor eyes were just lifted far, far above the mundane reality of car sales.
But we have to drag the conversation back to that mundane reality because that's what fundamentally anchors the future, right?
It has to.
Even with all the hype and the focus on robotaxis, the core insight we need to hammer home for you is that the baseline automotive operation, it is still critically important. You can't build that software future without the hardware foundation.
That's absolutely essential. I mean, look at the company's current revenue structure. Vehicle sales and, related products still make up the lion's share of their income.
It's the cash cow.
It's the revenue anchor.
Mm.
It's what funds the billions of dollars needed for all that advanced AI research, for R&D, for scaling robot production. If that anchor starts to drag, the whole strategic timeline gets thrown way off.
And it's not just about current cash flow. That shareholder vote, the one that solidified the CEO's compensation, it also formalized a set of incredibly ambitious strategic targets. And if the baseline operation falters, two of those targets become, well, exceptionally difficult, if not impossible.
Let's look at the sheer scale of those promises. The first one is a physical manufacturing target. The company has to deliver a total of 20 million vehicles globally.
20 million. Just to put that into perspective for you, I mean, the global auto behemoths like Toyota or VW, they aim for around 10 to 11 million vehicles per year.
Right. Now, 20 million is a cumulative target, sure, but it still requires them to ramp up production aggressively year after year without major interruptions. A 3-year low in a market like China throws a huge wrench into that continuous ramp-up.
It's a marathon, and you need to be running at full speed from the very start. But the second target, that's where the old business meets the new business directly, and it's arguably the more fascinating and riskier promise.
That would be the requirement to achieve 10 million active subscriptions to Tesla's self-driving software.
10 million active subs.
Yeah, and think about that for a moment. You cannot have an active subscription unless you first sell a physical vehicle for that software to run on.
So the car isn't just revenue.
The car sale is the necessary gateway to the recurring, high-margin software revenue stream that is supposed to redefine their entire valuation.
That makes the China sales dip suddenly look, I mean, catastrophic, doesn't it? It's not just a drop in one quarter's revenue.
No.
Every lost sale today, in a market that big, represents a lost opportunity for decades of recurring subscription revenue down the line.
It creates a tremendous compounding problem. And this brings us back to why the China sales dropped. It's not just, a cyclical issue. Our sources point to the hyper-competitive local landscape.
Companies like BYD.
Exactly. They aren't just competing on price anymore. They're building attractive, high-quality models that really resonate with local consumers, and they've been aggressively expanding their lineup while Tesla's core models have aged a bit.
So you have aggressive, state-backed, and consumer-focused local competition basically eating into Tesla's demand.
And that forces them to send cars that were meant for China to Europe or other markets. That's a fundamental business challenge that no shareholder vote can magically fix.
Right.
And while the market often waves this away, believe me, investors still monitor the vehicle baseline very closely, quarter to quarter. We saw this with the most recent quarterly delivery numbers. They came in higher than expected, which was good news.
But there was an asterisk.
A huge one. Much of that demand was likely pulled forward because of the expiration of U.S. subsidies. So even when the baseline numbers look good, the underlying demand drivers are constantly shifting, and, well, they require very careful analysis.
Okay, let's switch from the strategic landscape to the immediate market pulse. We have a stock that's caught between this bullish optimism of a confirmed future and the bearish reality of manufacturing struggles.
A classic tug of war.
So for the listener who wants to know how the strategic tension is actually manifesting in the market right now, let's give you a snapshot of the technical analysis.
Absolutely. So to set the stage, you have to understand the high and low watermarks. The 52-week high for the stock sits way up there, near $488.54.
Okay.
While the 52-week low is much further down, around $214.25. That alone shows you the massive volatility the company operates within.
A huge range. And given that the stock is wrestling with this conflicting information, a China problem versus a robot vision, how does that internal conflict show up in the current technical health check?
Well, we can look at the Relative Strength Index, the RSI 14. And that reading has been hovering around 57.7.
Right, so kind of in the middle, not too hot, not too cold.
Exactly. When we see a number like that, it tells us the stock is currently balanced. It's neither overheated and overbought, suggesting it needs to cool down, nor is it oversold due to, widespread panic.
The market is waiting.
The market is waiting. It's reflecting the indecision between the strong, bullish, long-term narrative and the immediate bearish operational risks.
That makes perfect sense. The technical data is just reflecting the strategic indecision we were just talking about. So if the market is balanced, where are the key pivot points? What tells us which way the stock might break next?
The current near-term trading zone is very tightly defined. Daily support sits around $425 to $427.
Okay, that's the floor.
That's the immediate floor. And resistance is very close, around 430 to $436. Those are the walls that are defining the action right now.
So what are the scenarios?
If we look at the potential paths, the bullish one relies on a stronghold above that $425 support. Some fresh positive catalyst emerges, say a big announcement about robo-taxi deployment, and the price gains strength.
Then what?
Then a move toward the upper end of the recent trading zone, maybe $460 to $480, becomes highly plausible. A sustained breakout past that $488 high would require some truly massive news to validate the future valuation.
And what if the sales narrative starts to weigh heavier? Or we get more disappointing news from the global manufacturing effort?
That brings us to the bearish scenario. If the price fails to hold that crucial $425 support level, especially if it's on higher trading volume, there's a distinct risk of a pullback.
And a pullback means...
That would likely mean testing the next major support level, which is the 50-day moving average. Right now, that's sitting around $418 or potentially lower. That would be a signal that the market is prioritizing the current revenue pressures over the future vision.
And I guess there's a third option where it just does nothing.
The neutral or consolidation scenario is also very possible, especially given that balanced RSI. We could just see the stock trade sideways between roughly $425 and $440, reflecting that ongoing market indecision until the next major piece of news forces a break one way or the other.
It really is a fascinating high-stakes moment for the company, caught between a rock and a robot.
That's a good way to put it.
We've pulled apart these two really distinct realities for you. The undeniable operational pressure shown by that 3-year low in China sales versus the ambitious, now formalized path forward driven by that critical shareholder vote.
A tale of two Teslas.
It is. And what these recent reports highlight, I think above all else, are the crucial leverage points. You can't just jump straight to the software future. You absolutely must successfully sell the underlying hardware, especially in markets like China, no matter how exciting the software is.
The baseline manufacturing capacity is the engine. It's what generates the fuel for the AI ambition.
That's the entire story.
It is. And as we conclude this deep dive, consider this final thought that really connects all the sources we've reviewed today. We established that the maximum strategic payout relies on two major targets, right?
20 million vehicles delivered and 10 million active subscriptions.
Exactly. So if the current sales momentum falters and they struggle to hit the continuous manufacturing targets they need to reach 20 million cars, that fundamentally makes the 10 million active subscription target exponentially harder to hit. The highest stakes variable isn't just delivering the physical car, it's guaranteeing the recurring software revenue. So if a critical market like China becomes saturated or shifts toward local competitors, how much does that current market slip erode the eventual success and profitability of the new subscription-based business? That is the real trillion-dollar question facing investors right now.